Hi, my YouTube subscribers, my learners, my students, my young Indo. Please share, spread the word, subscribe, download the video. It's completely free of charge. What is important is for you to exceed your own expectations in this subject and get that distinction. Above all, I desire that you get understanding. I desire you get understanding. So remember, guys, we've been doing cash flow from financing activities, cash flow from investment activities. Today, I just want us to focus on cash flow from operating activities, which is the last section in the cash flow statement. So what I did, instead of starting from the top to the bottom, I started from the bottom up. The reason I did that, your cash flow from financing activities and investment activities is pretty straightforward. Your cash flow from operating activities, it's a bit, I don't want to say challenge or tricky. It needs a bit of work. So I would rather build your confidence on the easy parts of the cash flow. Then we go and tackle the parts that need more of your concentration last. So cash flow from operating activities, guys, it always carries high marks. Sometimes the reason I'm doing this cash flow in a deconstructed fashion is because you would have noticed not many a times they ask for the full cash flow statement to be constructed. They'll be asking bits and pieces of the cash flow. So it means you must master each section and know how to answer it thoroughly rather than knowing it from top to bottom. Obviously, I'm going to do one from top to bottom. I'll be using the deconstructed pieces we've created in the previous YouTube videos, just for you to see the complete picture. And then we can move on to analysis of financial statements, which is very, very, very interesting. Okay, guys, let's start with the theory. Remember, I said if you want my notes and my slides, this is not my slides, this is just a framework. So if you want a detailed notes or slides, just send me WhatsApp on 081-833-9231 or send me an email on moyophatiswa@gmail.com, moyophatiswa@gmail.com. Now, all my resources are going to be uploaded in a website that is being constructed, which is my notes, detailed notes, and all. They'll be uploaded in my website. Okay. And also some detailed courses on the matters relating to accounting and business. So thank you, guys. Let's just start with this. So this is the framework. You know me by now. The client name is important. And then now this is the section in the cash flow that talks to cash flow from operating activities. So it will be cash generated from operations, which is usually not one. Which is usually not one in the cash flow statement. And then it has to be adjusted. The cash generation from operations has to be adjusted to interest paid. That is, you subtract that, dividends paid, tax paid. The main reason we're subtracting those, you just want to see the money made out of the pure existence of the business. So you just want to see the cash received from customers. That's the essence of cash flow from operating activities. You want to see the cash received from customers and the cash paid to suppliers. That's what you want to see. But now, because of the nature of the income statement, it's all encompassing. It includes sales made to customers, cash and credit sales. It also includes expenses made to suppliers and operations. And some of those expenses are not cash related. your depreciation, credit losses. Yes, they are not cash related. So in order for you to see the money movement in the business opening or operating, you have to adjust those items that are not operational related. Okay. Remember, the interest that you put in here, it's critical, guys. Always remember, the interest that is put there is the interest that's not capitalized. Okay. So note number 1, which is cash generation from operations. So it's your profit before tax is important. So if you are given profit after tax, you must adjust it back to profit before tax. And then you take out depreciation. In fact, you add back depreciation. You add back depreciation. Why? It's a non-cash item, so it would have been subtracted. Remember, in your calculation for profit before tax, you would have subtracted depreciation. So you need to add it back because it's not cash. So mathematics, let's say your depreciation, you subtracted 5,000. This is non-cash. When you want to know the profit made, you have to add back the 5,000 so that your net effect is 0. You don't want something that is a non-cash item. So that's why we're adding it back. It's because it was initially subtracted. Okay. So you add back interest expense. You're adding it back because you're gonna take it out in the body of the cash flow statement. Guys, let me make sense of this. Your profit before tax, you would have subtracted finance charges, which is your interest expense. Now that you're going to record it in a separate line in the cash flow statement, you need to take it out completely when you're doing the reconciliation of profit before tax and cash generated from operations. You need the nil effect of, let's say again, interest was 5,000. You would have subtracted the interest expense. Now you want to take it out completely. You're adding it back because you're going to subtract it here. I hope it makes sense. No? Then changes in working capital. So So changes in working capital. It's your inventory, debtors, and creditors. So if your inventory is more than what it was last year, it's an outflow because it means you bought stock. Then if your inventory is smaller the current year compared to the previous financial year, then it simply means you didn't buy much stock, so it's an inflow. So if your debtors are smaller or your receivables, if your Receivables are smaller this year compared to last year. It means people who owed business money are paying, so it's an inflow. If it's more, then it means people are taking and not giving us money, so it's an outflow. If our payables are more compared to what they were last year, it means we've negotiated with the customers and we can retain money on our side. If the payables are less in the current year compared to the previous year, it means we've paid suppliers, so it's an outflow. Now you know the truth. Let the games begin. Yeah, I just wanted to move that. Okay, guys. This is an IEB question paper. I'll say again, I'm not a representative of the IEB. I did not develop this question paper. I am not the examiner in this question paper. I'm an accounting teacher who hopefully wants to end up examining and doing amazing things in the IEB and the Department of Education world, like specialist in accounting also. But for now, I'm not that. So this is not my work. So this is a question paper that's available to the general public. If you go to the IB website, you get this question paper. All I'm doing is trying to teach you excellently so that you understand what is expected in this question and how I would have answered it, or the best way I recommend to answer this question. Now that I've done the disclaimer, thank you guys. Let's get into business. Now, we're looking cash flows, question 3. See, it's 50 marks. Okay. So, your client name is important. First of all, what do they want you to do? That part, we filled it in previous videos. I just want to get rid of this thing now. This thing. Anyways, it's annoying me. But let's continue. Okay. So they want us to complete the reconciliation note before tax and cash generated from operations. It's 18 marks. So what is your client name? Thank you, fine. Your client name is Simelane. It's Simelane Sources Limited. And what they want you to do is to complete note 1. Just trying to copy this, guys. Bear with me. So here's this one. So this is the working capital. Okay. They give us net profit before tax. Yes, they gave it. So we just copy it as is. Okay. Depreciation, do they give us? Yes, they gave us. Is there a story? Is any story that talks to hey, before we are loans? Okay. Dividends. Okay, there is no story affecting. Yeah, because guys, adjustments are very important. So we can be flying through and you just loading something before it's adjusted, so you lose marks there. Interest expense. Let's see, did they capitalize interest? Okay, so they're showing us loan repayments including interest. So we need to know the interest part, or they're saying interest is capitalized. So in this case, whether it is capitalized or not capitalized, we just need to know what's the interest portion on it. And don't mind the hood, guys. Oh, smaragdi. Oh, yeah, interest. What happened? Okay, it's fine. Hey, okay, not gonna fight with this anymore. It keeps on doing that. equals to 271 500 minus okay. Then we see things. The changes in working capital. The movement in trade and other receivables resulted in a outflow of cash 152. So that you don't need to calculate, guys. It's given to you. You put it as is, and they told you it's an outflow. I think you'll get it 1 mark here because you don't need to calculate. You didn't do anything. Sometimes you won't even get a mark for it because you didn't do anything. Then we need to do our payables. So the income tax part, we're not gonna include it in our payables because we adjust for it separately. We adjust for it separately. So the income tax, so we'll include the other parts, which is VAT, but not the income tax and shareholders for dividends because these are adjusted separately. So 696 ngimkhohlwa kanjani X, guys? 624. What did I do? 4,000. Let me wrap text, which equals to, let's see. Hey guys, I'm sleeping on the job now. This problem, it's supposed to be a plus. I am sleeping on the job. Apologies. But I really know it doesn't make sense. There is the minus. Which is 17. Just want to write it down so that you can see which side is bigger than the other one. This is 24 plus 17,000. It's for 5. Now, guys, you can see you can see that the payables for this year have increased compared to the payables of last year, which means this in actual fact means we have maybe negotiated longer payment terms with the suppliers, so we're holding on to more supplier credit, or this means we purchased from the suppliers using credit more than using cash. So this would be treated as an inflow. This one, we're told it's an outflow. There was no secret about it. Now we need to do inventory. Remember, guys, I said this is heavily integrated with maths. We've got the inventory for the previous year. We don't have the inventory for the current year. Now we need to solve for X. So for loans, dividends, financial assets, investment activities. Oh, they give us something that we can calculate inventory using. So remember, current ratio is your total current assets divided by your total current liabilities. And then your asset test ratio is your total current assets minus inventory over your total current liabilities. Now, this can give us what we want, meaning, okay, to put perspective, let us just log in. Let's just log in. I want to show you these formulas in case you don't believe. Mm, formula sheet. Okay. Maybe it's high time I save it. But this stuff is really cluttered. Mhm, mhm. So now I'm just looking for the current ratio is your current assets divided by your current liabilities. Your asset test ratio is your current assets minus inventories. This you'll be given in the exam and you must just apply it. So in this case, you are given, so you need to solve for X. So if the total assets, which is what makes up the total assets, if you're still struggling with this in grade 12, go back to the theory on assets, uploaded a YouTube video called assets, so just go through that. Your total current assets is your inventory, your debtors, it's your inventory, your trade and other receivables, your cash and cash equivalents. So your asset test ratio takes out inventory because they say it takes longer to convert it into cash. So if the total assets are 2.2 and assets without inventory is 1.5, then what is inventory? So in this case, we solve for X. So I won't write it here because calculations. Okay, so X equals to 2.2 minus 1.5 equals to 0.7. And they've given you total current liabilities. So it means when we're dividing these assets over the total current liabilities, they give us less inventory. They give us 1.5. Including inventory, they give us 2.2. So now we have to take out the inventory part in the equation. And the liabilities are going to help us because we know for sure of the asset test ratio that it is 1.5 if you divide by 13676. So we're using the value of the known to get the value of the unknown. So this will be the inventory. The inventory part. So let's try and prove it and see if we're getting somewhere. In fact, we'll say 376 just to prove if it's giving us any of the answers we want. Do we have to be that's not giving us. Not giving us what I wanted to prove. Because if our liabilities is 1, 2, hey guys, guys, 1276. Yeah, there you go. That's what I wanted to prove. Now we can solve this yes thing, which is 963. So meaning we purchased more this year, so it is an outflow. Okay. This is not one. Now I want us to do this. So now we need to do the interest paid. Let's do this. Okay. Hey guys, now we need dividends paid. and tax paid. Okay. Let's see if X takes us somewhere to calculate the dividends paid. Drawing on dividends. Both interim dividends, the dividends were paid. Given to you. How amazing. So they gave that to you. You don't need to calculate for it. Calculate it. I doubt you'll get a mark for it though. I wonder if it's breaking it. Tax paid. They did not give it to us. History. You're given balances and this and that. Let's see if X can help us to get somewhere. So X is we have this balance. We have this balance that we've paid. We have this balance that we have overpaid. We have this balance that we have paid. This is a liability at the beginning of the year. So we would have paid it because you have to do your 6 monthly payments to SARS, the interim payments. So we would have paid 34,000 in 2021. Just copy it. Okay. Then they didn't give us the tax. Which is $475,800. So the amount that we would have paid, because now is overpaid, the amount that we would that actually we have paid is this plus let's try another method. If you're my student, you would have done this at the beginning of the year. Liability account. Okay. So we have a balance brought down on the credit side. can draw this. You can draw this general ledger in the space provided. You can draw it. And income tax for the year. Equals to 7 Okay. Then the assumption is that we overpaid because our account is sitting on a debit, which is an asset. So the assumption is that we've overpaid with 9,000. Because we've overpaid. Balance. So can you see? We still get the 518. So the tax paid is 518, 800. Okay. Okay, guys. Balancing what was given. I hope it makes sense to you. I hope this makes sense to you. Let's check the memo. Don't mind the noise, guys. Okay. Yay. Guys, like, subscribe, share the content. Bye.